I'm Andrew Moran, Liberty Nation's economics editor.
Very, very rocky.
Death by government.
Drain the swamp.
Hello and welcome to another installment of Liberty Nation's Swamponomics videocast. I'm Andrew Moran, Liberty Nation's economics editor. This week, be prepared for a climate of high interest rates. So says the International Monetary Fund. The global financial organization published its latest World Economic Outlook, and it covered a wide range of topics from growth to inflation to interest rates. On the monetary policy front, sticky and stubborn inflation could keep interest rates higher for longer than previously expected, the IMF cautioned in its latest report. While the IMF does anticipate that the major central banks will start cutting interest rates in the second half of 2024 and into 2025, the group's economist contends that elevated inflation is, quote, holding up progress on both reducing inflation and lowering interest rates. One area that the IMF is concerned about is services inflation that they say is being caused by higher wages. IMF chief economist Pierre-Olivier Gourinchas told journalists after the report's publication that energy and food inflation have returned to pre-crisis levels throughout the world, though overall inflation has not. He added that ballooning services prices and wages could result in persistently high inflation and pose a, quote, significant risk to economic growth in the developed world. Indeed, services inflation has remained elevated. In the United States, services price inflation clocked in at 5% in June, down from 5.2% in May. Within this category, there are price pressures throughout the industry. One sector that has contributed to the price inflation bomb in recent years is the limited service meals and snacks category. You can think something like McDonald's, Burger King, or if you need a double-double, Tim Hortons. This has soared 29% since 2019. By comparison, the broader consumer price index has increased 21% cumulatively in the same span. But wages contributing to inflation has been a cause of debate among economists. While the mainstream opinion is that labor is inflationary, opposite wings of the economics field assert that higher pay is not causing inflation. What causes inflation? The expansion of the money supply. But that's another story. Even the chief money printer, the Federal Reserve, be it the Boston Fed or the San Francisco Fed, suggests that wage growth has not been a primary inflation driver, though they tend to ignore what has been the chief cause of it in the first place. Now, back to interest rates. The Fed is desperate to cut rates, though monetary policymakers are pretending to be conservative and coy. In several public appearances over the last month, Fed Chief Jerome Powell made quite the admission. The central bank does not have to wait to loosen monetary policy before inflation reaches the 2% target. This is fascinating because Powell has contended on multiple occasions over the last few years that the Fed would only cut interest rates once the annual inflation rate is sustainably at the 2% target rate, not tapping it once and then moving on. The European Central Bank, overseeing a regional economy that is barely growing, wants to finally move on cutting interest rates. The Bank of England, despite reaching its 2% inflation target, has refrained from cutting rates. The Bank of Canada, which is still witnessing inflation above its 2% target, was the first G7 nation to cut rates. Maybe it's because the Great White North's economy has been lackluster under Trudeaunomics. So, what's happening? Perhaps some are paying attention to the wisdom of economist Milton Friedman. He contended that if you wait to act on monetary policy, whether raising or cutting the policy rate, then you might have waited too long. This was evident during the coronavirus pandemic when inflation was beginning to surge, and everyone insisted that inflation was transitory. By the time the Fed pulled the trigger on a rate hike, the inflation tsunami was already flooding the nation. It might be the opposite today. Inflation is easing toward 2%, so it is time to cut interest rates. Of course, the data suggests that the US could be reliving the time of the 1970s and 1980s when there was intense volatility in the consumer price index, forcing the Fed to cut rates, cut rates, and raise rates. Still, even if inflation reaches the 2% threshold tomorrow and even falls below the level, the equities building has conceded that it is unlikely interest rates will be the way they were before or during the pandemic. In other words, the chief policy rate will continue to be elevated. This is seen in the June summary of economic projections, with Fed officials forecasting the median policy rate at around 3% in 2026 and beyond. So, what was the benchmark Fed funds rate in January 2020? 1.55%. Ouch. That's it for me this week. Please read my full Swamponomics column on the pages of LibertyNation.com, and be sure to check out my previous Swamponomics TV videos and interviews. Thank you. I'm Andrew Moran, Liberty Nation's economics editor.
Very, very rocky.
Death by government.
Drain the swamp.